Hi guys, welcome back to another video. So today I will be talking about the second Q full year 22 or 23 for Maple Logistics Trust financial results. So this analysis would be quite interesting as there will be a lot of things that we can learn from their earnings call linking to their presentation slides as well. So for the earnings call transcript, you can read it from the Seeking Alpha website, which I will post the link in my description below. Not sponsored by them, it's just a interesting or a good place where you can read transcripts for free. So recently a lot of REITs has been hit hard by the interest rate. So in this video, we'll see or analyze through Mapletree Logistics Trust and see whether there is any red flags or what are the potential upsides that we can get away from these results. So for those who are new to the Mapletree Logistics Trust, here is an overview of the asset under management and the gross revenue. As you can see, most of the majority of the revenues are coming from Singapore, China, followed by Hong Kong and Japan. So this is very important of the composition to take note of, especially for China later on down in the video where I will show you more about the analysis behind it. So for those that are new also, they are a pure logistic REIT. So because of this, logistics are still in demand. So their prospects of doing well and being very resilient is very good. Moreover, they have a very good track record of being a 10 years REIT in Singapore and has constantly do well with good management decisions. Okay, so before we dive right into their earnings, we'll look at the key highlights. As you can see, for the key highlights, the gross revenue increased 11.4% year over year, whereas for the NPI it increased by 10.8% year over year. Similarly, for the DPU it increased by 3.5% year over year. However, if you compare quarter and quarter, the DPU actually declined, which we will see later. So for the portfolio occupancy is at a lower range of 96.4%. If you have followed my previous video based on Fraser Logistics and Commercial Trust, the logistics side actually had a very good occupancy of 100% as compared to Mapletree Logistics Trust. However, this cannot be compared apple to apple because for Mapletree Logistics Trust, they have a lot of logistic buildings in different countries, whereas for Fraser LNC, they are only having logistics in Australia and Europe countries. So we will see more later on what is causing the occupancy to drop or to be a lower value. So similarly for the rental reversion, this is good because the rental reversion means that new tenants are coming in with a higher rental payment of at positive 3.5% throughout the whole portfolio with an average lease or tenancy of 3.3 years. Whereas for their proactive capital management, they have a higher end leverage of 37%, which might restrict their opportunities to purchase new acquisitions in the upcoming, if possible, recession, and the debt of average 3.6 years with the debt hedged at 82% into fixed rate. And this can be understood from the earnings call that their fixed are at 4 years long, so which can be a good thing in times of higher inflation and or higher interest. Moreover, they have a 72% income stream hedged into SGD because, as you know, just now, based on the portfolio, they have a lot of different countries with different currency. So because of this, it's important for them to hedge it into SGD to stabilize the income and reduce the forex impact. Moreover, they have also acquisition in Malaysia and active rejuvenation of a Singapore property as well. Okay, so let's take a look at their earnings result. So as I mentioned before, I normally do not like to compare year over year because the year over year values are good. So I will be focusing more on the quarter over quarter because recent interest rate and environment changes have caused big changes or big differences into their performance of the REITs. So as you can see, for the gross revenue, it actually decreased 2% year over year, whereas for the property expenses, it decreases 2.3% quarter over quarter as well. So as you can see, they have actually stated quite clearly here nicely. So revenue decreased mainly due to lower occupancy in Singapore and China properties, whereas for the depreciation of the respective currency has also affected the income. However, this can be a very good thing, especially if you follow the recent currency changes, that these currencies are actually coming back stronger against SGD. So this might actually play a very good thing for Mapletree Logistics and upcoming quarter results. Okay, so the management have been able to mitigate the currency or forex impact by hedging some of it. However, this has also still in the end caused a drop in the distribution, or because most is because of forex impact. So for the property expenses, lower property taxes expenses caused the amount required to be paid to have dropped, partially offset by higher allowance for doubtful receivables. So this is actually very dangerous, because this actually meant that some tenants might not be able to pay for their expenses or their rentals. Their borrowing costs also increased partially due to, as you everyone know, higher interest rate. So during the earnings call, it's quite interesting to actually hear that the impact of the forex has been greater than expected. As to me it's greater than expected, because as you can see, the forex impact, as stated by the management, have hit them hard by 5% drop in DPU. So actually, if the forex impact was not there, this DPU might have actually been an increase quarter of 5% instead of a decrease of 0.9%. Okay, so for the debt wise, they have not much difference, but their leverage actually dropped slightly by 0.2%. This was due to the lower net loan translated from the depreciation of the currency. So that is one good thing about depreciation of currency against our local SGD. However, I would prefer it to be stronger, so that the income coming in would be much higher as compared to the amount of debt that they have to pay off this debt. However, and they have a decent average interest of 2.5% with 82% hedge, as I mentioned just now. So if you look at the debts, they have used a very different approach as compared to MIT, which focus on translating their loans to USD to keep it there. Whereas for Mapletree Logistics Trust, they would hedge the loans into their respective properties countries, as you can see here, which might give MLT a slight advantage when it comes to currency, comparing it to SGD, because these currencies are weakening, so this indirectly translates to cheaper loans to pay down. Okay, so looking into the next portion, I want to focus on the additional part, which is the rental reversion part, as I mentioned just now. So overall, it was actually 3.5%. So from the earnings call, you can see that they have actually helped to specify different regions as to where the rental reversion, or how well different countries are doing. So as you can see, the best was Australia at 8.1% of rental reversion, followed by Vietnam of 4.2%, and Japan 4.1%, Singapore 4%, Hong Kong 3.2%, Malaysia 3.1%, South Korea 2.6%, and China of 2.5%. However, China was actually the main focus throughout the earnings call, as a lot of analysts was actually questioning about the China properties because of the China lockdowns. And this is a very good green flag that you can take away, that I feel that, in my opinion, will do well for MLTs, because China has recently opened up. So during this period in October, there were actually still concerns about there was no stoppage on when the lockdown would end. So because of this, next few quarters might benefit Mapletree Logistics Trust, considering that they have a lot of properties from China. Okay, so for the occupancy rise, you can see the overall portfolio is at a lower value of 96.4%. This was actually due to the major properties or countries that have pulled down the overall occupancy, which is Singapore and China. So during the earnings call, you can actually learn a lot of information about how these respective countries are doing. So let me first say that for the other countries such as Japan, Hong Kong, Vietnam, and Australia, they have constantly said that they have gotten a lot of demands. So their demands there is not an issue because there's not enough supply of logistic buildings. So for Singapore, it decreased a bit slightly is because of the preparation for the improvement works and converting from single asset users into multi-tenant builders. So I'll explain more about the benefits of it later. So let's focus on China, which there was a lot of talk about it as well. So China wise, they have a two-tier property, which is tier 1, which is the luxury side, whereas for tier 2 is more of the SME or smaller sites. So because of this, tier 2 has a lot of yearly lease rather than 5 years lease in other countries. So because of this, the turnover might be faster or might be unstable as well, and this might have caused the decrease. However, one interesting thing that I would like you to take away is that the tier 1 is actually still doing well, especially for the luxury side in China. So because of this, the China properties might improve subsequently, or we have to focus on it because China is opening up now. So technically, their occupancy should do better with higher demands. Okay, so if we look at the top 10 tenants, they have actually decreased CWT, which is the major tenant, quite a bit from 6.3% to 4.4%. So through this, they have done it by converting it from a single user asset into a multi-tenant base. So although single user asset has pros and cons, single user assets can be cheap when you have a tenant. However, if it collapses or it stops paying, they will cause a very huge occupancy swing and an increase in the expenses for the REITs, which is stated by the management. That's why, because of this, converting to multi-base tenants for every tenant is a good thing to mitigate all this fluctuation in occupancy and providing a more stable income. So if you look at their acquisition or strategic acquisition, they are intending to buy a Malaysia building, logistic building that is in KL to Port Kalang. So because of this, they have actually mentioned during the earnings call that for Malaysia is also one of the higher yield countries based on the properties, and moreover, Vietnam is also another one that has provided a 7 to 8% yield of return. So because of this, I expect or predicts that these two countries might be their focus for properties in the coming future. So by comparing Fraser Logistic and Commercial and to Mapletree Logistics Trust, Mapletree Logistics Trust sometimes might be a more attractive investment when investors like me would prefer to have a pure logistic REIT rather than having a mixture of logistic and commercial trust. Moreover, Mapletree Logistics Trust has a lower occupancy at 96.4%, but as I mentioned with regards to the China environment, they might benefit from it greatly in the upcoming quarters. So we'll have to take note of that as well. So what are the things that we can take away from these results and use it for the subsequent quarters? Firstly, currencies of different countries are slowly becoming stronger as compared to SGD. So because of this might benefit Mapletree in a way that their revenue might go up and their income. However, their expenses or debts might go up as well. So we'll see how does it offset each other. Next, occupancy in China should do better because of the recent China openings. So we'll also focus on the management costs and see what do they talk about. Thank you so much for watching. Recently, I'll try to change formats of videos here and there and making sure that I can provide additional knowledge or things that cannot be easily seen from the slides or reading from anywhere else. So because of this, I hope you enjoyed the video, and please hit like, subscribe and comment on what things that I can do on or further improve on. Thank you so much for watching, and I'll see you in the next video.